Hi everyone, this is Demel Gonzalez of Heartwood Financial Services. Welcome to another edition of the Market Update for January. You're in for a treat as always. We're going to have lots of interesting topics. We're going to be talking about COVID variants, GameStop stock, and of course, as always, the outlook for the markets. So stay tuned, stay watching for the extended edition, and please feel free to share. Thanks a lot. Okay, as always, let's start with the asset class returns. First of all, let's start with the domestic large cap stocks. As you can see, they were down a little bit. We're showing you here the 1 month and then the year to date, which of course is the same. But large cap domestic stocks down about 1% for the month of January. But then as you can see, and it's pretty dramatic on the scale of this chart, how small cap stocks were up 6.29%. That's a huge difference. And this is really carrying on from the last quarter. So again, small caps continue to outperform. Small caps tend to be a little more cyclical, more economically sensitive. So the market's definitely telling us something there, right? We're also seeing real estate continue to do pretty good, doing a little bit better than the domestic large cap at 0.53 positive for the month. Now, also negative were developed market stocks down, negative 0.82, and emerging markets on the flip side did great. They were up 2.6 or 2.86, which is a very nice outperformance there to their big brothers, the developed markets. Thankfully, we've had good exposure in these areas that have been outperforming. These are those cyclical areas that we've been talking about for the last few months. On the fixed income side, we're seeing bonds were down a little bit, about 0.5%. The high yield, lower quality bonds actually did a little better, ironically. Really just down fractionally, 0.07. And then gold. Gold has been a little bit of a disappointment, down 1.44%, with inflation starting to creep up just a little bit and all the stimulus and all the potential stimulus coming. You would think that gold wouldn't do as well. But with the U.S. economy starting to turn around, it's actually been, the dollar's been strengthening just a little bit here lately, and that's hurt gold some. But of course, that could just be a short-term blip. We'll have to see what happens for the rest of the year. All right, for the market update, I have it titled as, is January just a pause or is this a reversal? Well, that's a big question. So let's talk about that. First of all, the COVID-19 hospitalizations are down pretty significantly. I've been tracking them every day. Believe it or not, I do that. And they have been going down just about every day for the last 2 or 3 weeks. So this is a very, very good sign. You'd think the market would be a little bit happier. Well, on the flip side, we have the COVID variants. It sounds so evil, the variants. But, what's been happening is we got South Africa, we got the UK, and even the Brazil variants that are being thrown into the mix. And, we're not sure exactly how the vaccines are going to cope with these new variants. Now, some preliminary studies are promising, but again, any uncertainty you throw out there gets people a little bit nervous. And I think this was probably the number one reason the market kind of stumbled a little bit because of that variable. Now, again, on the flip side, very positive, strong earnings so far. In fact, the article that I read recently about the earnings is that we're on track to tie the best earnings surprises that we've ever had since FactSet, which is the company that tracks these things, has been tracking it back in 2008. And so we're seeing a very good, compared to expectations, mind you, earnings. We're still, these are fourth quarter earnings that are still, bad in the absolute sense, but relatively speaking, doing much better than expected. So again, you would think the market would be doing pretty good because of that. Well, that is true, but on the flip side, the market's also getting a little bit concerned over all the speculative trading that's going on. You've heard of GameStop and AMC and some of these trades that have been propagated through Reddit. Well, I'll talk more about that when you get to the detailed section of the video. So stay tuned for that. But last, we have leading indicators improving and probably more stimulus coming. And so as you can see, I am still thinking that this is probably more of a pause because things just continue to improve. And not only improve, but there's additional carrots, so to speak, that are out there on the horizon that could make things get even better. Okay, now for the outlook. I've titled this, Can Optimism Improve? It is pretty high right now. But believe it or not, I think it could improve even more. And so let's talk a little bit more about that. First of all, and probably the most important piece to improve and to continue this optimism is how the vaccine rollout has been going. And from what I could see, it seems to be accelerating. So it started off a little slow as we were learning, how the heck to do all this. But it seems like we're getting our act together. We're north of 1 million vaccines per day. And an article I just read, which we'll talk a little bit more in the extended version, is we should be at herd immunity by the end of the year, which means basically back to normal, which would be pretty amazing. Now remember, it doesn't require for everything to be back to normal for the economy to dramatically improve. So we're talking back to normal. That would be pretty amazing. And that would probably be a surprise, which could help optimism even more. Infrastructure spending. Now, this isn't even baked into the cake. This is where they would spend on roads and airports and tunnels and train tracks. And that could potentially be a lot more spending, which could be good for the economy, at least in the short run. And with more Democrats in the Senate, the possibilities of these things passing did go up a little bit. So there could be some more of that coming, which would be a positive surprise and could help move the markets up a little bit more even. And so with that outlook, what are we doing at Heartwood? Well, I'm still using the barbell approach. And if you remember, I talked about this back in the middle of last year, how we've been setting aside some things that are a little bit more conservative and counteracting it with things that are a little bit more aggressive, kind of a barbell approach. I wanted to take advantage of things coming back, but at the same time, there's still so much risk that we wanted to balance that risk with some more conservative things. And so we're still using that same type of strategy. I just tweaked it a little bit, and we'll get into that a little bit more in the extended version, but it's essentially the same concept. And then the last thing is really we're still optimistic for the year. The short term, because of the high speculation, the valuations being a little high, and these variants that are throwing a little monkey wrench into all the great news that we've been talking about. I'm thinking at least in the short term, just taking a little money off the table, being active with that rebalancing and taking some of those gains, cashing those in, but continuing that barbell approach overall, because I still think we're going to have a pretty good year. Okay? All right, for the educational slide, I wanted to talk about the importance of dividends. So this is a slide that shows what contributes to the return of the S&P 500. The yellow is what's called multiple expansion. The pink is dividends, and the orange is earnings. And so what's interesting, as you can see from this, is more time goes by, more and more of the stock's total return is attributed to basically two things: earnings, which is the orange, and dividends, which is the pink. So when it comes right down to it, it's earnings plus dividends. Okay, multiple expansion, that can happen throughout the year. Some hot stocks that are out there, they go way up. Zoom videos, some of these, maybe they'll start showing that earnings growth and they'll continue. But for right now, it's a lot of multiple expansion. And so it's very important to look at the dividends and not just look at the growth. Now, on the flip side, I would also add that sometimes people focus a little too much on dividends. They like to find those high dividend stocks. What oftentimes can happen is those high dividend stocks can have very little to no earnings, sometimes even negative earnings. And so you're going to be missing out on half of the potential returns in the long run if you just focus on dividends. So if you look at the portfolios that Heartwood is managing, I do focus on dividends quite a bit. In fact, I have 2 positions that are particularly focused on dividends. This is how important I believe dividends are. The 2 are Vanguard funds, VYM and VIG. So I think dividends are very important, and especially in this low interest rate world we live in, it might even be even more important. Thanks. And as always, I like to end with an inspirational quote. This one comes from the book of Proverbs. Very good book, by the way, on finances. You should check it out. It reads like this: "Do not wear yourself out to get rich. Have the wisdom to show restraint. Cast but a glance at riches, and they are gone, for they will surely sprout wings and fly off to the sky like an eagle." Ouch. When I read this, I thought immediately, if your main focus is about money and making money and becoming wealthy, it does tend to elude you. And even if you do get those riches, you sometimes, I think that sometimes you miss out on the journey and enjoying your family, your friends, the time that you could have had, making a little bit more out of just enjoying your life. And so this kind of reminded me of that. I read an article that had this quote in it, and they were talking more about risk and risk taking, and kind of like all the speculation that we've been seeing and people just trying to get rich quick. And I could certainly see how that fits there too. It's not about getting rich quick. It's about accumulating wealth over time at a nice steady pace, and doing it without, again, just wearing yourself out. Okay? So hopefully that's a message that hits home for some of you, like it did for me. And I hope you guys have a great one, and we'll be talking to you again soon. In the market update, you heard me talking about the hospitalizations being down. And thankfully, it's not just hospitalizations, it's also the cases. Although, unfortunately, deaths are still kind of hovering around a high mark. But again, that's a lagging indicator. But you can see here the blue line of the cases have been coming down dramatically, and the yellow line being the hospitalizations. So to me, that is a really good precursor that deaths are going to be coming down. And as those numbers start to come down, there's going to be a little bit more confidence in the economy, jobs that are starting to open up again. So there's definitely some good signs coming in the economy. Now, is this all because of the vaccine and the vaccines? I don't know. It might have a little bit to do with it. There's probably a lot of variables a little bit beyond my control and understanding here, but the sign does look good. So in the market update, you heard me talking about how speculation is on the rise. And one of the examples I brought up is what's going on with GameStop and AMC and some of these stocks that you've heard about in the news. So I wanted to just give you a quick explanation of what's going on. So first of all, this is a list of the top 10 stocks that are being shorted. Now, shorting means that you are selling a stock you don't own. You essentially are borrowing it to sell it. And the only reason you would ever do this is because you think the stock's going to go down even more. Okay? And so what they do is they buy it back later when the stock is cheaper, and they make money that way. I know it seems almost a little unethical, but it is legal. Okay? And it's being done a lot, especially by hedge fund managers. And so these folks on Reddit, which is some social media platform that I guess a lot of traders like to get on, and they like to talk about their latest ideas, somebody came up with actually a pretty smart idea. They saw this list or something like it, and they saw how GameStop is very heavily shorted. In fact, it has more than 100% of its shares that are outstanding that were sold and shorted. So what they did is they said, why don't we buy GameStop and force those big Wall Street hedge fund managers to have to buy their stock back because there's different margin requirements and things like that, or because they don't want to lose anymore, to buy their stock back. And that would actually make it go up even more. And so we actually saw that happen. A lot of smaller traders kind of joined forces and bought, for example, GameStop and many of these others that are on this list, made the stocks go up, and then there was what's called a short squeeze where the people that were shorted had to go and buy it on top of it and made it go up even more. So it was pretty crazy. It is very interesting to see. I don't believe that what's going on here is a systemic issue. This is more of a temporary thing. It already seems to be subsiding, but it is an interesting thing when you think about it that social media can help people join forces to move the markets kind of like these big hedge fund managers can. Pretty interesting stuff, huh? Okay, and I talked about the leading indicators too, and they keep improving. We still got a long ways to go, okay? But the economy improving is what the stock market wants, not a good economy. Sometimes the market's down when the economy's good. It's about improving. And so what you can see here, one of the biggest ones that I watch are the initial claims, the initial jobless claims. And it was down pretty good last week. And it was down actually more than expected. And so as that continues, that is a good sign that the economy is really starting to recover. And that's not including more of the stimulus that's in the works. So you heard me talking about in the market outlook how the vaccination rollout has been doing pretty good. In fact, it's improving. I found this chart that I thought was really great because it shows the rate of vaccinations per day and how it's been steadily going up. Now, it's been plateauing here recently, but we're at plus 1 million per day. And according to their calculations, which were at about 1.3 doses per day, we would be at herd immunity at about 11 months, which would be about at the end of the year. And so that would basically mean when things get back to normal. So when I saw this, I was actually very encouraged because back to normal by the end of the year, I don't think too many people are anticipating. We're just hoping for improvements this year and not necessarily back to normal. So this could be a very good thing for the market and continue the optimism. And for my last slide, I want to just review the barbell strategy, which is kind of the theme that we've been using for the last year or so with the portfolio, and that is counteracting the risk with some conservative things and doing it strategically. So on one side, we're continuing to hold growth. Growth stocks have actually been kind of defensive. When the vaccines weren't rolling out yet and the virus was really bad, growth stocks were doing really great. Things are starting to reverse a little bit, but there's some really good stocks there. Even though they're a little expensive, I'm still holding because I still believe in the growth story of a lot of these stocks. On the flip side, I'm also still holding on to those high quality bonds. I've actually been buying a little bit more as I've been doing some of that recent rebalancing. So that's on the more conservative side of the barbell. On the other side of the barbell, we have continuing to add to those cyclical stocks, the small cap stocks, the value style stocks, the international stocks, okay? But also continuing to hold those more risky types of bonds because yields are very low. Looks like yields are maybe going to go up a little bit. That might not be great for those high quality bonds, but will be okay for those higher yielding bonds. So taking advantage of all that, but not going all the way to one side or the other. Okay, makes sense? Thanks.